Hello there, this is Shirley Lou bringing you another wonderful episode focused on finance. And you know what? I'm very excited, of course. The last episode you may have seen Justin Hayman sitting here next to me. I got so excited because I said, you know what? I got to have Justin back. And when I have him back, and today there's going to be a subject that Justin kind of brought to my attention. He goes, Shirley, last time we talked about all these other wonderful things this IUL life insurance can do for, when you buy a house, when you want to buy a loan, and you do all these wonderful things. But one of the things I want to talk about was, I've got a bunch of nieces and nephews, and they talk about they want to put money in 529 plan and all these other stuff. So, Justin, why don't you kind of share with the group again? Welcome back with us, and share with the group again about who you are again.
Well, I'm Justin. I hail from the real estate and the mortgage industry. I'm a partner with Shirley in the insurance industry, and I do have a lot of nieces and nephews, and most of them are very young. So after learning about insurance and learning about all these great things Shirley has and all these products, I wanted to ask her, what should I be doing for my nieces and nephews? I want to have little $1 million babies everywhere. And so how do I create that?
So how many nieces and nephews do you have?
12.
He got 12. 12 nieces and nephews. You know what? They're gonna love the uncle by the time you're done on this.
Well,
they're
I hope
gonna,
so.
They're gonna love you. Well, thank you so much for asking. And a lot of you guys out there may be grandparents that have grandchildren, grandkids. I, for example, have 4 granddaughters. And one of the things I'm passionate about is because I always recognize that down the road, the biggest expense gonna come is college, right? And one of the greatest gift someone can give is to pay for the college education so that when they graduate, they don't have that debt over them.
Mm-hmm. That's amazing.
Yeah, and I think one of the things you also recognize, Justin, for a fact that there are a lot of students out there that owes hundreds and thousands of dollars.
Yep.
And they can't get down under. It's practically like a mortgage. Now think about you're 21 years old, graduate from college, 22, and you suddenly have this debt that you have accumulated.
Well, and it never goes away like a mortgage. It seems to always stick around.
Exactly. So if you can give them a head start in life without having that over their head, it'd be the greatest thing. And one of the things we want to talk about today is Justin talked about his nephew. Now, what do you think the biggest concern when it comes to the parents when it comes to kids that you see? College? What other issues that you see with these kids?
College, education, and also just them being safe and being able to be taken care of if something happened to the parents.
Exactly. So for the kids, I, for example, have 4 granddaughters, okay? And we decided to open a life insurance IUL. Now, some of you guys out there probably disagree with me and saying, well, wait a minute, why are you buying life insurance for little kids when they don't really need it? It's not just about life insurance, guy. It is a vehicle that allows for you to accumulate money inside a life insurance growing similar to the market return.
And life insurance has that connotation at first, like, oh, I'm only going to use it when I'm dead, or somebody only gets a benefit when I'm dead. That's not true. You get benefits while you're living. And life insurance takes care of you in many different ways. Policy loans, living benefits, disability benefits, lifetime care.
Lifetime, yep, income. Yeah, you're right. So when we do, let's talk about your 12 nieces and nephews, right? So you open this policy for your 12 nieces and nephews, it does really 5 major things. You ready?
Mm-hmm.
The very, very first thing in life is that, number one, they're getting a life insurance protection at a young cost, where you can lock in the rate, pretty much. It's a very reasonable price, right?
Yep.
From young. Because sooner or later, those little young ones could have grown up to be like an adult like you and I. And they're going to have families. They're going to have things that can happen to them that they're going to need that protection down the road, So I guess that's the first thing. And the second thing is you talked about, remember the living benefits, mm-hmm. right? So imagine your granddaughter, your grandson plays football when they get 14, 15, and they get hurt really bad playing football, right? Well, imagine having a policy that can also cover these kind of things. And then, how let me ask you this, young kids, do they sometimes love to go snowboarding, skydiving, do all craziness stuff sometime, right?
Well, of course, kids are kids, so they're going to get hurt.
Right. So with them getting hurt, having an account that protect them in case those things happens, because you don't know what's going to happen. Or make it something simple as they're driving a car. What if they try to be a good driver, but some bad driver hits them, and they're hurt really bad, they can't move, can't eat, can't bathe, any of that stuff. This can also becomes, instead of not just a death benefit, becomes a living benefits, right? That they can use. Another component about the life insurance I talked about that besides leaving a tax-free death benefit legacy, besides all the living benefit, is called accumulation. Remember those kind of funding where you say, gosh, you know, your niece and nephew are going to go to college one day? Imagine if we start structure it, fund it the right way right now, and that money grows, compounded interest, tax deferred, and when the parents comes in and take the money out to pay for college education, is tax-free.
When the policy rolls over to the child,
Yeah.
when they get of age, would they be able to take a policy loan against the...
For right now, they're young, the parents own the control. So with that being said, yes, the policy loan is available for them to, the parents goes in or the kids goes in, take it out as a loan, take out 10,000, 100,000, 30,000, you know, whatever amount that they need for that semester to pay for that college, and they take it out as a loan. There are no taxes consequence. And again, do I have to pay back the loan?
Not till the policy's up to date, meaning not till the insured passes away and the death benefits.
Or if you want retirement, then you pay it off early, right? And then you pay off the loan. So it's an option that you can give someone to do, right?
Yep.
Now let's talk about a myth, another biggest myth. You don't make any money inside the life insurance. The return, you don't make any money. So under the IUL, what kind of return can you make inside an IUL? You can make 4 or 5% guaranteed like you normally, like a whole life. But inside an IUL, it's got different funds that you can pick and choose. Now, don't quote me on this because I'm going to go, oh, she said this on television. But there are years, guys, inside an IUL that can make 10, 20% return. And when the market loses, it locks it down. Now, that's not guaranteed because the market can't always sustain up. But I do know one thing for sure, guarantee. And you can say this, the market's either make money or it's going to lose its money. You're either going to make money or you're going to lose its money. In life, the only difference is that you did have an index performance product, whether it's an IUL index or you can have an index performance under the FIA, fixed index annuity that I talked about, where you can make all the gains, but the floor is zero. You know, kind of like zero your hero kind of deal.
That sounds great.
So with that, being said, it gives an opportunity for growth inside the market. Now, why is that important? It's important because you told me you needed money for the kids' college, right? But what happened if that kid gets older and begins to go to work? And they're going to start thinking, wow, I've got this account that my uncle set up years ago that you can put more money into it, create an account where they can save this money for the future as a retirement. Because you started years ago. They could front load a lot more money into the account because they're not working.
Okay.
And that when it's structured, when they turn 65 or 60, the account begins to distribute a tax-free stream of income for the rest of their lives.
Wow, that's amazing. That's amazing.
There's so many clients of mine that we structure for the kids college funding when they need it. Mm-hmm. And we also structure that, well, what happened? They turn 35, 40 years old, they want to buy the first home. Take the money out for first home. And then, okay, well, what happened if they turn 65? They need money then. Oh my God, you can have so much fun with this stuff.
So me starting a policy for them now, would that help them provide a down payment for their first home? Absolutely.
Oh. Remember, again, it's about structuring. Now, folks, don't tell me you'll go out there and say, oh, Shirley Lou, I decided, let me give you $50. It's funny about life, right? People give me $50, they expect me to create like millions. I don't know, it's like, how's that going to be happen, It's all about structuring properly I call them $1 million babies. I have to tell you about $1 million babies before we get off, right? So the $1 million baby works like this. I told you I have four granddaughters, so we structured like I put in like $200 a month. Now, is $200 gonna break somebody's banks?
No, that's not bad at all. That's only $2,400 a year.
That's correct. So a lot of parents and grandparents gives, instead of buying a bunch of toys and other stuff, they give this a separate gift. Guy, it is the greatest gift you can give to your kids. Nieces, nephew, daughter, grandson, I don't care what it is. And the way I structure is that for the first like 4 or 5 years, maybe I do $200 a month. Mm-hmm. And then as I have more money down the road, maybe a couple years later, I increase it by another $50. So I go to like $250 a month, okay, for a couple years. And then if I have more money, then I maybe add another $50, maybe go up to $300. So you see how you're structuring this and layer and layer?
Yeah.
Increase it as your money comes available and all that. But if I didn't, if for some reason you didn't have the money and your niece and nephew, you keep it the same payment. It doesn't hurt. All I'm saying is that the more money you put in it, the more we have a chance and opportunity to grow.
That's amazing. That's amazing.
I call it $1 million babies. And you know what? It is incredible if you learned it early and teach early, But, I'm really glad to see that you're looking out for your nieces and nephew, the kind of things,
Well, thank you so much.
Yeah.
So what does the account value look like when, let's say, you start off when they're maybe 10, 11 years old? By the time they're 30, 40, what does the face value of that account look like?
So it depends, again, back to the amount of money they give. So if a parent's, really going in and said, okay, you know what, I want to put $200 a month. Some parents, oh gosh, we don't have enough time to even go into it, but there are so many amazing, if there are those kids that are 18 years old, there are accounts where parents can create a 5-year retirement plan.
Oh, really?
That's another episode, you buddy. That's another episode we're going to talk about. But in this particular case, you can do a couple $100 a month, and the kids can have, about $500,000 policy with, cash value and all build up.
Oh, cool.
Well, Justin, I'm so glad that you're here. And guys, I'm really excited. I want to connect with you guys. Justin, your contact, please.
You could always email me, justin@mcclain1.com.
Okay. And Shirley Liu, you can reach me at, again, Google me, L-U-U, Shirley Liu. My number is 703-608-1203. We're excited because why? I believe we rise by lifting others.